love the channel and find it useful in becoming a happy retiree. Subscribe today. Scarlett, what's going on? Welcome to Money Matters. How can I help?
Thanks for taking my call, Wes. I am pretty well set for retirement. I have a pension. We'll assume that Social Security's there, and I have a fairly significant 401k. And my question is, when I die, I have a will with an estate, have 3 children, everything will be going to them. But what happens to the 401k that was tax-deferred savings? I know that if I were to take it out, I need to pay tax, but how does it happen with my heirs?
So for your heirs, Scarlett, as long as they are a listed beneficiary on your 401k, which obviously you can do, right, your children inherit these as they become an IRA for your children. Typically, they roll into an IRA, and because your kids are named beneficiaries, it becomes what's called an inherited IRA. It's not their own IRA, even though it's their money. It stays in the form of what's called an inherited IRA, a beneficiary IRA. Different custodians or different investment firms have different titles for them. But the rules are that they have to take out a required minimum distribution, even if they're really young. Let's say they're in their 40s or 50s. They now have to take out money, but it's over their long lifespan. So these are also end up being referred to as stretch IRAs because they only have to take a little bit of money out every year. Let's call it a couple percentage points of each in any given year. They've got to take money out, so they don't have to pay a penalty on it, even though they're younger than age 59 and a half. So it's actually a good financial planning tool or a good estate planning tool to have your children listed as beneficiaries of either your 401k. Same rules, Scarlett, apply to a regular individual retirement account or an IRA. Again, they will inherit it as what's called an inherited or beneficiary IRA. They have to take money out, but it's stretched out over a really long period of time. Just to note, it's important to note that it's different than what happens when you have a spouse inherit an IRA. When you are a spouse, so let's say husband leaves IRA to wife or vice versa, there's an election you can make, and you effectively have a choice. So let's say if you are married and the husband passes away, wife inherits this IRA. She can leave it as what's called an inherited spousal IRA, and that allows her to take money out without penalty, even if she's younger than 59 and a half. Still have to pay taxes on the money that comes out, but at least she has access to it. Or you can effectively, as a spouse, make that IRA now just become your own IRA, and all the rules that apply to your exact individual retirement account now apply to this new. It effectively becomes your own IRA, and all the same rules apply as would on your normal individual retirement account. So Scarlett, hopefully that helps, and I appreciate you listening to Money Matters.
Thank you very much.
Hi, I'm Wes Moss, and thanks for taking a minute to hear about what's so different about my new book, You Can Retire Sooner Than You Think. So unlike other retirement books, this book will give you a step-by-step guide, whether you're in your 20s or 30s or 40s or 50s, to learn from what these successful and happy retirees did to get there. I hope you enjoy the book, but more importantly, I know that it'll help you retire sooner than you think.